All right, hello, welcome to our review kit. Okay, so let's look at a very core important part of the syllabus. Which why I call it core important is because this has just been introduced into the syllabus, and this area is part of it why the syllabus was changed. Sustainability reporting and the sustainability what standard. So we want to run through them because honestly, like if all things being equal, at least some one or two questions should come out on sustainability reporting. And this subject has been incorporated into almost all courses, whether it's SBR, whether it's financial reporting, whether it's even other courses like that. You still have a bit of sustainability reporting incorporated into those courses. So let's look at sustainability. What sustainability reporting? And then we'll touch briefly on those standards. The thing is that although it is not yet applicable, I think the earliest application is January 2027, but still we need to start learning and understanding them. So although I don't expect very comprehensive questions on it, but you still going to have some questions, likely some questions on what sustainability. That's why I want us to spend time to look at what sustainability reporting. Okay. Alright. Now let's move on. Before let's move on. Look at what we call movement from social and environmental accounting to sustainability reporting. Now, before what you have or what you call you hear more of social and environmental accounting. And in fact, ICANN has tested this SEA. I call it SEA severally in previous diets, but let's look at it now. Now, the progression from social and environmental accounting to sustainability reporting reflects the expanding scope and expectations of corporate accountability and transparency over time. So what I said is that the investors, users of financial statements are expecting more accountability and transparency from companies, which is now why we now have sustainability reporting. In fact, you have standards backing them up now. Now, this evolution is rooted in the changing priorities of stakeholders, particularly investors, regulators, and the public, towards more integrated and forward-looking disclosures that align financial performance with environmental and what social impact. So it's just not your financial performance. How is your financial performance affecting the environment and society? They want a more what a more integrated, and that's what led to what sustainability reporting. Now, let's start from SE, which is social and environmental accounting, before we move on to sustainability. Now, the Foundation Social and Environmental Accounting emerged in the 1970s and 1980s as part of corporate social what responsibility. So CA was more of what CSR, trying to build that good corporate image. It focused on social accounting. That is, social accounting is what reporting on human resources, employee welfare, community engagement, diversity, and human rights. So social accounting will look at also what's your area, how do you handle your staff, how do you treat your staff well, how do you engage with your community, what are the projects you do there. So you can see that was more from a CSR. Okay. Then environmental accounting was concerned with what? Pollution. So how does the business affect the pollution, resource depletion, and what? How do we effectively manage waste? So now, but there were some limitations with social and environmental accounts, which led to sustainability that we have now. So let's look at what are the limitations that we have. One, okay, lack of standardized merits and metrics and reporting what framework. Okay, so that's one of the limitation we had with social and environmental accounting. There was no standardized metrics. There were different reporting frameworks. So there was not a single one that everybody know that this is how you report on your social and environmental what issues. Then disconnection from financial statement and business strategy. It was just a report that didn't directly link it to what your financial statement or financial figures in your financial statement. So well, like a separate report. Let's talk of social part. Let's talk of environmental part. But linking it directly to financial statement was not there before. Now, minimal influence on investor decisions or capital allocation. So it was just more of a CSR thing. Perception as a public relation or compliance exercise rather than strategic what risk management. Now, that now leads to what you call sustainability reporting, which is what we're going to thoroughly dissect now. Now, with growing awareness of climate change, biodiversity loss, inequality, and UN Sustainable Development Goal called SDGs, companies and investors began demanding a more holistic and integrated view of what corporate performance. This led to the emergence of what we call sustainability reporting. Now, what does sustainability reporting does? One, please, there are three things in sustainability. Unlike SCA, please note them down. One, sustainability will talk about environment, we talk about the social impact, and also what governance, that what we call ESG what dimension. So these are the three areas. We talk of corporate governance too. So these are the three areas that is what sustainability reporting. Okay. It links sustainability risk and opportunity directly to business model, strategy, and what? Financial outcome. So it's not just a separate report. We're now integrating it with our what? Our finance, our strategy. How do you intend to go about this? How does environment and social things affect our business strategy? All those things are incorporated into what? Just sustainability reporting. Then provides quantitative metrics, not just qualitative. So there are metrics that you can use now, target and forward-looking what? Insight to judge what? Sustainability. Okay. Seeks to inform capital providers and improve long-term decision making. Now, let's look at what sustainability reporting is now. It's because becoming mandatory in many what jurisdictions. In fact, like I said, we still look at it. There are now standards for it, and it's compulsory for companies that to now, according to the board or ISB, we still look at it. It's not compulsory to what to do what sustainability reporting. Then it's closely tied to financial materiality with increasing scrutiny by investors, regulators, and what rating agencies. So is very closely tied to what? Financial materiality. Okay. Then aligned with framework. So we now have frameworks. That's what we're going to look at now. Which is IFRS S1/S2. Then we have Global Reporting Initiative Standard. We have SASB. That's for what? The US. We still look at all those things in this. And TCFD, which is Task Force on Climate Related Financial what? Disclosure. So sustainability reporting is trying to integrate all these things, make them, like I told you, one of the challenges with social and environmental accounting was that it was a bit scattered before. But now it is what? It is together. Then sustainability reporting is the structured disclosure of an entity's environmental, social, and governance performance. So please, like I said, note those three words. When you're looking at sustainability, look at three words: environmental, social, and governance what? Issues or performance. Risk and opportunity that affect the long-term ability to create what? Value. So when we report on those things or we disclose those things, it's called what? Sustainability reporting. Okay. Now it provides stakeholders, especially investors, with insight into how an entity is responding to what? Sustainability. And I mentioned the three issues in sustainability. So how is an entity reacting or responding to one, its environmental impact, the activity? Oil and gas companies, they have a very large impact on the environment. How is the company responding to it? And we're going to link this with our financials, not just our CSR. Then two, we look at what? Social issues, the social impact of business. We also consider that. Then lastly, governance issue, ESG issues. Now, the goal is to present comparable, verifiable, and material information that helps users assess the impact of sustainability risk on financial performance and what? And decision making. Now, let's go. What are the key features or components of sustainability reporting? One, unlike social and environmental accounting, it is forward looking. Includes what? Scenario analysis, forecast, and strategy what? Alignment. So we do scenario analysis under sustainability reporting. We also do forecast. Okay, so in the next 5, 6 years, what's going to be our impact? If we continue this, what's going to be the impact on the environment? All those things. And then how do we align that with our what? Our strategy. Okay, like I said, so it's no longer standalone. Then it's materiality driven. That's another thing for sustainability. Now, focuses on ESG, environmental, social, and governance issues that could affect enterprise what? Value. So now we look at issues from a material. We still look at that as we move deeper into sustainability reporting. Is what? Look at what? Materiality is also very key, very important. Then it's quantitative and also qualitative. It's not just qualitative. Now you have quantitative factors that you use. Combines KPI, which is called key performance indicator. So we look at emission, water use rate with narratives, then e.g. governance practices. So like I told you before, social environmental accounting was more qualitative. We just say the things we do. So this year we have tried to reduce this so that we can reduce our carbon dioxide emissions. We have done this, but now please we are going to look at KPI. That is what? Indicators, financial, like quantitative indicators. So we look at them. Then integrated with financial information, increasingly aligned with financial reporting standards. So now that's why it's called IFRS S1 and S2. Now they are trying to also make it what? Make it compatible with what? IFRS or reporting standards. So you can comfortably do it in your what? Financial statements. Now, what are the methods of reflecting sustainability impact, or what are the methods you can use to report sustainability in your financial statement? One, you have what? Narrative disclosures. This was what was very common before. Management commentary on notes. Discuss how ESG risk affect business models, cash flow, and access to what? Capital. That's narrative. So we just explain, then explain sustainability strategies, governance structures, and risk management practices. Provide forward-looking statements about climate adaptation, emission target, and what? Compliance risk. They have your financial statement what? Impact. Okay. Now, ESG factors can lead to recognition, measurement, or disclosure in core words core financial statement. That's the game changing thing about sustainability standards. Now, you are going to measure some things in what? In your core financial, your statement of financial position, statement of profit or loss, cash flow, changes in equity. Now, let's take some examples of how that impacts. Now, for example, climate related asset impairment. That's why I said, you see that sustainability has been incorporated into standard. IS 36, you can now report on what? Climate related asset impairment. What are your assets that have been impaired based on what? Climate changes. That's now captured in IS 36. Carbon taxes or emission trading obligations. Now, you now have in some advanced countries, you have what? Carbon taxes that you pay or emission trading obligation. You have some liabilities that might come from what? ESG. And so what do? You also incorporate that into what? IS 37. You apply IS 37 to that. Then the commissioning or environmental liabilities, IS 16 and IS 37 will handle that. Supply chain disruptions, inventory write down under what? IS 2. Restructuring due to sustainability strategy, that's IS 1 and IS 10 disclosures event after the reporting date. Then ESG related investment. Now you now look at IS 38, which is intangible, and then IFRS 9 on financial statements with the now you can see that it's very robust framework, because you can see that now we'll start using standards to deal with what? ESG issues. Okay. Now let's get metric and target IFRS S1/S2 frameworks now. Uh like I said, it's now quantitative, so not just stories. You now put figures to your stories now. We are to disclose key performance indicators such as greenhouse gas emissions, energy use, water intensity, and waste levels. We are to provide progress against sustainability targets, e.g., net zero goals. So we are going to look at what KPIs, what are green gas emissions in terms of quantitative measures, energy use, water intensity, waste levels. Those are metrics that we measure in quantitative terms and report in our what? In our financials. We show financial implications of ESG risk, e.g., cost increase and what? Capex allocation. So what part of our capital expenditure are we dedicating to what? To handling sustainability issues. So are we building new factories that are not going to use so much of what? Release so much of emission of carbon dioxide? How much of our capex is dedicated to that? All these are financial metrics we talk about. Then we do scenario analysis. Use structured model, e.g., 1.5 degrees Celsius and 2 degrees Celsius climate scenarios to assess resilience and stress test what? Your financial assumptions. Okay. Now, look at international standard promoting integration of sustainability with your normal financial reporting framework. Okay. So now, framework that guide integration of sustainability into financial and narrative reporting include, so we now have IFRS S1, which is what we're going to briefly look at. General requirement for disclosure of sustainability related financial what? Information. So we must disclose that. IFRS S2 talks of what? What are the climate related disclosures that you must make in your what? Financial statement. Then have your integrated reporting. That's another framework. Okay. Integrated reporting emphasize linking between ESG and what? Value creation. Okay. Then you have GRI, focus on impact on our what? On our stakeholders. We have SASB. We should look at all these things one by one. Sector specific financial materiality metrics, and TCFD recommends narrative and quantitative disclosure on climate what? Risk. Now, what's the importance, or why is sustainability reporting such a big deal now that in fact we're incorporating to almost everything, and then you hear a lot of sustainability reporting these days? Sustainability reporting, why is it becoming a big issue? Okay, let's look at this now. One, we're using it to assess enterprise risk resilience and long-term value. So please, sustainability is now part of your core risk management, because is a big risk that we should consider the impact of activity. And since a lot of laws and a lot of government and investors are putting more emphasis on what? Sustainability, we have to look at the impact on that or on risk management. Okay, then it helps us align portfolio with ESG standards or sustainability indices. It helps us understand how ESG issues influence capital expenditure, regulatory exposure, and what? Reputational risk. Okay. Now, what are the factors responsible for increasing demand for sustainability? That sustainability is now the new game. What are the things that led to that, both internationally and what? Look at this is testable in the exam. I'm sure that these are areas that can actually ask questions. So, this can explain 5 factors that is making sustainability a core issue in financial reporting today. So these are the things you want. One, we have international factors. We look at both from an international perspective, that is worldwide, and then a Nigerian perspective. One, we have climate change and global environmental what? Crisis. Climate change and global environmental crisis. That's part. So of course you have climate change now. The climate is, everybody understand the impact. And so that's why a lot of emphasis is now on sustainability. Okay. Then two, investor and capital market expectations. Now, institutional investors and asset managers increasingly integrate ESG factors into what investment decision. So some of them, if you don't have a good ESG framework, they will not invest in your company. So now that all these institutional investors, all these insurance company, trust funds and all those, sorry, they're now strongly what strongly requiring companies to what comply with ESG. Okay, regulatory development and mandatory disclosures. Jurisdictions like the EU, USA are implementing mandatory sustainability reports. So it's no longer an option, it's now mandatory. In fact, in Nigeria, we'll see how we want to adopt ESG, and it now becomes mandatory for Nigerian companies. Okay. Rise of ESG ratings and indices. Companies are assessed by ESG rating agents. Now you have agencies that rate company on their what ESG. So that's why it's very critical that companies comply with what ESG. Okay. All right. Now let's look at some local factors driving the demand for sustainability in Nigeria. Now, the Nigerian Exchange Group, or let's call it Nigerian Stock Exchange, mandate listed companies to disclose ESG practice, focusing on governance, ethics, environmental performance, and social welfare. So, like I told you, it's now compulsory in Nigeria. So Nigerian regulatory bodies are also emphasizing strongly what sustainability. Okay. The NGX rule book encourages alignment with what the GRI framework, UNGC, and other global what standards. Now let's look at the FRCN, Financial Reporting Council of Nigeria roadmap for IFRS 1 and IFRS S1 and S2 adoption. Like I told you, it's now going to be adopted in Nigeria, but there's a roadmap or a way we are going to adopt it now. The FRCN has issued a clear roadmap requiring phased adoption of ISSB standards for IFRS S1 and IFRS S2. One, firstly, is that entities must now undergo readiness assessment, submit implementation plans, and develop what ESG framework. So before they start, one, so we assess how ready are companies, especially listed companies, to start what reporting on ESG. Have they started what developing their ESG framework? So FRCN will actually ask and request for those things. Then the FRCN has issued a clear roadmap requiring phased adoption of ISSB standard. Okay, now let's look at it. Where is it? Okay, all right. Sorry, there's somewhere. Where is this thing? Let me see. I think it should be down here. I want us to quickly look at that roadmap if it's here. Okay. These are the limitations of ESG. Oh, it's not here. All right. Remind me. I'll go back and I'll get that for you. Okay. So is in phases. There's what we call, okay, yeah, it's still there. We still get there. So don't worry. When we get there, I will refer you back to this now. Let's look at another very testable area. Please write this down. What are the key limitations and problems with what? Sustainability reporting. What are the challenges with sustainability reporting? Very testable in the exam. These areas that examiners can ask questions on ESG. Okay. So one, lack of standardization and global uniformity. You have multiple framework. You have GRI, you have SASB, that's the US. US is not adopting IFRS S1. They have their own standard. Some European countries use GRI. You have TCFD, you have CSDB, and now you have what? ISSB, which is IFRS S1 and S2. So you have multiple reporting frameworks. So for some companies, especially for international companies, they are confused. Which one do they adopt? Some of their subsidiaries will use GRI, some will use SASB, some will use what? ISSB or IFRS S1 and S2. So that's one of the challenges. We don't have a single framework. We still have different frameworks, and they require what? Different things. Two, uh, without harmonized standard, users find it difficult to compare disclosure across entities or what? Jurisdictions. It's just the same thing. So imagine a company that is using SASB, which is a US company, and another UK company that is using IFRS S1 and S2. We can't easily compare their disclosures about ESG because the standards are requiring different things. So it makes comparison what? Difficult. Okay. Differences in interpretation of materiality and disclosure boundaries further reduce or make comparability what? Difficult. The other thing is data quality, availability, and reliability issues. Many of the data required for ESG or sustainability reporting are not what? They don't have data system for tracking ESG metrics. For example, let's take a basket Nigeria. How do we track green gas emissions, or we track our water usage? All those things we need very core scientific data. So for countries like Nigeria, that's going to be a major challenge. Where do we get quality data to report on what? Sustainability or ESG framework. Okay. Then subjectivity and ambiguity measurement. Certain ESG factors, e.g., social impact, governance, quality, biodiversity, are difficult to quantify because they are qualitative in nature. You can't have a standard. This is the way it's supposed to be. Or so everybody uses their judgment or subjectivity to report on this thing. So it also makes it less reliable. Then greenwashing and reputational risk. Some companies publish superficial or misleading sustainability reports to appear responsible without making any substantive changes. So they are just saying that even with all these reports, some companies will just package their reports, write a lot of goodies. In actual fact, they are not implementing or what, or ensuring that they are complying with what, ESG or sustainability. Then cost and resource constraints. That's another thing. Very comprehensive sustainability reports can be very expensive because you have to get a lot of experts to do that for you in that area, and time consuming, particularly for SMEs. For listed companies, of course, they have the financial capacity and they have the technical capacity, but for SMEs, that is going to be quite a big challenge. Okay. The lack of enforcement and assurance. In many countries, sustainability reporting is voluntary. Like I told you, although in Nigeria it's going to become mandatory, but many countries is voluntary, and then there's not so much implementation. Just write report. Who is monitoring actual what? Actual implementation of these what? Of these frameworks. Okay. Then inadequate internal capacity and expertise. Now, where assurance is performed, it is often limited to what? Limited in scope, and not what, is not mandatory. Many organizations do not have trained personnel who can report and effectively handle what? Sustainability or ESG issues. We now have to start training or getting people to become professionals in that field to what? To start reporting. And that's a very lucrative area just on the side. If you really start looking at where can you get skills on ESG, because ESG is going to become a big issue. In fact, I know some people that are really starting to go down that line because it's going to be a very lucrative career opportunity. That's by the side. Okay, now let's look at GRI, which is called Global Reporting Initiative. What is GRI? GRI is one of the most widely used international standards for sustainability what? Reporting. Okay, all right. It's a stakeholder-oriented framework focused on an organization's impact on the economy, environment, and society, regardless of whether such impacts are financially what? Material. Okay, so now this GRI focus on the impact, like I told you, is more stakeholder driven. What's the impact of the activities of organizations on the what? On the stakeholders, your shareholders, your community, your creditors, all those users that we have, or stakeholders. What's the impact of ESG on their what? On their on them. Then now, what are reporting principles? One, like I told you, stakeholder is very important in GRI. So anytime you see GRI, you talk of stakeholders. Okay, identify and respond to expectations of all the keywords stakeholders. Sustainability concepts, present performance in the wider context of environmental and what? Social limit. Then it talks of materiality. Okay, so GRI also emphasizes material. We only report on what? Issues that are what? Material, on our financials or what? Stakeholder concern. So we don't report on very material issues. We look at materiality loss when we talk of what? Sustainability reporting. Then completeness. Ensure the report includes all relevant topics across time and boundaries. Balance. Present both positive and negative performance what aspects. So ESG say that don't just present the good part. Let us know about the bad part. So what are the negative impact of your activity on the business? Not just talk of your CSR activities. Then comparability. It allows stakeholders to compare performance over time and across. And so if everybody's in GRI, you can easily compare what your ESG performance. Okay. Then accuracy, clarity, reliability. Now, GRI standards are modular and include one universal standard. So you have GRI 1 to 3, they have their own standards. Foundation, disclosure and principles, topic specific standards. Then it covers environmental, e.g. GRI 302 is what? On energy, social. GRI 41 is on employment and economic topics. GRI 201 is on economic performance and sector standards. So it covers a lot of what? A lot of areas. Okay, all right. All right, so now let's go down. Let's look at another one, another framework apart from GI. This one is applicable in the what? United States. They call it what? SASB, Sustainability Accounting Standard Board. So they have a board there that deals with sustainability now. SASB provides sector-specific financially material sustainability disclosure standard tailored for use by investors and what? Capital markets. Now, unlike GRI, which is more, like I told you, stakeholder focus, SASB focuses on investor relevance and financial what? Materiality. So what's the impact on the investor? That's for US. They are more concerned with investors, not other stakeholders. And we also look at what? Materiality. Now, what are the principles you have in your SASB? One, financial materiality. Focus on ESG issues likely to impact financial performance in a material way. Okay, then it's industry specific. That's the peculiarity that differentiates this one from other ones. They develop each standard for. So for oil and gas, their own ESG reporting or disclosure is different from a company in what? In car manufacturing. So they are different. Then decision usefulness, designed for investors and analysts making capital allocation. So like I told you, it's more targeted towards investors. That's their own framework. Then it's cost effective. Metric designed to avoid undue reporting what? Burdens. It doesn't want you to make it very cumbersome to report on. Then it's evidence based. Developed through research and market engagement. Now, for example, for the automobile industry, SASB may require disclosure of product fuel efficiency and regulatory compliance costs, and these are financial material in that what in that sector. So, like I told you, is what industry specific. Then now let's come to Nigeria. What's the guidelines of sustainability reporting? That is the Nigerian Stock Exchange now. The Nigerian NGX has issued sustainability disclosure guidelines for companies listed on the Nigerian exchange. These guidelines are aligned with global standards such as GRI, UNGC, and ISO what 26,000 and aim to improve transparency, attract sustainable investment, and encourage responsible business what practice. Now, please, what does this disclosure the guideline require? That's for the Nigerian Stock Exchange. One, governance and ethics, board oversight of ESG matters. Okay, anti-corruption and compliance what policies. All these things must be in place. Then environmental management is also part of their guideline. Emission, waste, energy, and biodiversity. Environmental risk and mitigation strategies. Value creation. Then marketplace. Then how do we come up with sustainable product and services? Customer satisfaction and innovation, capacity building and staff development, the human rights, CSR, all those things are what are part of what the Nigerian guidelines are talking about. Now, what's the reporting format? How does the Nigerian exchange want you to report on sustainability? Now, the NGX allows for standalone sustainability report, integrated report, or sections within what annual report. So there are three ways you can go about it. You can have a standalone, that means you have a report just like your financial statement. You have a sustainability report that is standalone. You can integrate it into your what your financial. So in your financial statement, you have both sustainability reports and what your financial reports, or you can take a section within your annual audited report or annual account and put sustainability words there. So those are the three reporting formats that we have. Then large companies, especially premium board listed companies, okay, are mandated to report, while others are encouraged to what report. Okay, now, okay, so that's the down. Now, positive impact on sustainability reports on corporate performance. What are the advantages, or what's the positive impact? Like this is testable to one, enhance risk management and resilience. ESG forces companies to expand their risk management beyond the traditional perspective and look more at what ESG issue. By identifying and disclosing ESG risk, e.g., climate change, social unrest, regulatory changes, companies are better prepared to anticipate and mitigate threats to their operation and what and their value chain. Then it gives us improved access to what to capital. That's an advantage. So now ESG conscious investors, once your ESG reporting is very key, they are ready to what invest in your company or invest in your what in your business. Okay, then transparency, it encourages transparency. Okay, it fosters stakeholders confidence because they can see that you are transparent about how you handle your ESG issues, enhancing customer loyalty, supply relationship, and employee what morale. Then it leads to a better corporate governance, enhanced corporate governance. The process of ESG reporting often leads to the institutional of internal controls, board oversight, and performance monitoring system that improves governance quality or corporate governance on a what on a general level. Okay, all right. Now, then better performance management, okay, and benchmarking. Now, what are limitations and challenges in reporting or performance impact on what sustainability? One, despite its benefits, sustainability also faces certain limitations in impacting corporate governance. One, short-term cost benefit burden. Implementing sustainability reporting framework can be expensive and resource intensive, like I said, especially for what SMEs. Then return on investment may take time to materialize. If you invest in ESG, it takes a while. For the next 10, 15 years, you might not get what return on your investment until after a while then you start getting returns on investment. Then ambiguity in measuring non-financial outcome. Some ESG metrics are qualitative or subjective, and then so it's not easy what measuring them objectively. Then risk of greenwashing. I thought greenwashing is just presenting on in your report that you are doing well with ESG, while in actual fact you are not really implementing what ESG. Okay, then weak enforcement and what assurance. Now, please, we're now going to look at IFRS S1. Look at different frameworks. Let's now look at IASB. They came up with their own standard, which is called IFRS S1 and S2, and this has been specifically mentioned in your what syllabus. Now, the IFRS Foundation officially launched the ISSB in November 2021 at the United Nations Climate Change Conference in Glasgow. The move was supported by global leaders, regulators, standard setters, and financial institutions who called for a unified sustainability disclosure framework. So instead of having GRI, having this, can we just have one single framework, just like IFRS 2? The ISB consolidates the Climate Disclosure Standard Board and the Value Reporting Foundation to now have what you call your ISSB. Now, what's the mission and objective of this body? One, we want to consolidate the Climate Disclosure Standard Board. Okay, all right. Then, the primary mission is to develop IFRS sustainability what disclosure standards that provides a global baseline for sustainability reporting. So just like for IFRS, let's have one single standard that talks of what sustainability reporting or ESG reporting. Then enhancing transparency, okay, promoting comparability and consistency across jurisdictions. So if everybody is using IFRS S1 and S2, you can easily compare, just like for IFRS based what financial statement. Okay, then supporting decision making by investors through reliable material and forward looking what ESG information. Okay, now as of now, the ISB has issued two foundational standards called IFRS what S1, general requirement for disclosure of sustainability related financial information. Okay, that's IFRS S1, and then you also have what, sorry, IFRS S1 and IFRS what S2, which is talking of climate related what disclosures. Okay, so IFRS S2 is climate. So IFRS S1 is what general requirements for disclosure of sustainability related financial information, while S2 deals with basically focuses on what climate change disclosures. Okay, now let's start from IFRS S1, which is what is even dealt with more. We don't have so much information on IFRS S2. Let's look at IFRS S1 in details. Okay, now let's look at some key components or summary of what you have in IFRS S1. One, you have disclosure of material information. Only sustainability related risk and opportunities that could reasonably influence investors' decision must be what disclosed. Like I told you, all those standards, whether it's GRI or those framework, GRI, SASB, they talk of what materiality. So only material ESG issues should be what reported on. Governance strategy, risk management, metrics, and target. These four core content pillars form the structure of what sustainability disclosure. So you talk of governance, you talk of your strategy, your risk management. They now talk of metrics and what metrics and targets. Okay, then it's industry based and general disclosures. Now, so one we have in this IFRS one, we have some that are peculiar to some industry, and we have ones that apply to all what all industries. Then it's forward looking. Okay, includes scenario analysis, target and transition plan, timing and location. Sustainability related financial disclosure must be published at the same time and the same report as financial statement. So it has incorporated it that you must. It's now an annual thing along with your what financial statement. Okay, now like I said, let's now look at this part. How do we intend to adopt IFRS S1 and S2 in Nigeria? One, applicable for accounting period on ending on or before 31st what December 2023. So it came into being in 2023 now. Entities that voluntarily disclose, choose to comply early, often multinational companies or those with strong ESG framework already in place. So, of course, some multinationals, because in their parent company, their ESG is very strong. Some of their subsidiaries are also required to report on it. So, there are some that have been early, we call them early adopters. They have adopted, even though it's not compulsory since what 2023. Then they are required to submit readiness document to the FRC and follow what assurance protocols. They have what you call the voluntary adopters. These are applicable for accounting period ending on or before 31st December 2026. You can see that it's not even applicable yet. Companies that elect to implement IFRS S1 and S2 ahead of the mandatory what deadline. So you can have voluntary people that even before deadline because they want to start adopting what we want to voluntarily adopt. Encourage to use this period to build capacity, assess gaps, and test what disclosures. Then you have the mandatory what adopters. These are the ones that is compulsory for them to what to do it. Effective for accounting period beginning on or after January 1, 2027. All applicable private sector entities in Nigeria will be required to adopt and report in line with IFRS S1 and what S2. Okay, so you can see that in 2027 is now what compulsory. So that means from probably 31st December 2027, we start having what it as what mandatory. Please note that it's mandatory for all listed companies and entities subject to what regulatory oversight. So, but for others, it is what it is optional. You can choose to adopt or not. So, if all listed companies on Nigerian Stock Exchange or stock market must do what must comply or start what adopting or doing it. Then for public sector entities, implementation details to be communicated later by RFC. So, sorry, I said RFC, FRC. So, please, for public sector, they have not come out with a deadline or implementer framework now. Internal control over sustainability reporting now. Okay, now then also have internal control over sustainability reporting, just like you have internal control over financial reporting, ICFR. Okay, description of the system, controls, and procedures put in place to ensure the reliability, accuracy, and verifiability of what ESG disclosures. Now, let's look at a bit IFRS S1. Let's just dig a bit into IFRS S1, what it says. Okay, now it starts from fair presentation. A complete set of sustainability related financial disclosure presents fairly all sustainability related risks and opportunities that could reasonably be expected to affect an entity's what prospect. Just like your financial statement, I would say true and fair view. For sustainability report, we must prepare a complete set of what fairly presented what disclosures about what sustain. And that means there should be no bias. Fair presentation requires disclosure of relevant information about sustainability risk and opportunities that could reasonably affect the entity's prospect and what and presentation. So we must be fair. Then another thing about IFRS S1, I've explained this severally, materiality. We only report what on material issues. And it is required to disclose material information about sustainability related risk and opportunities that could reasonably be expected to affect the entity's what protects. Okay, now information is material. If omitting, misstating, or obscuring that information could what? Could affect or influence decision by what? By the primary users. Just like for your normal materiality, the same materiality applies to your what? ESG. So if you ask in the exam, what is materiality as relates to ESG? You tell them that this is talking about we should report material information about what? ESG or sustainability issues. And materiality, if an item is omitted, is wrongly stated, or is obviously stated, it's if it can affect the decision of the primary users, then that information is deemed to be what? Material for sustainability reporting. Okay. When an entity applies IFRS sustainability disclosure standard, it is required to consider all facts and circumstances and decide how to aggregate and disaggregate information in the sustainability related what? Financial disclosures. Then reporting entity and connected information. Now, and entity sustainability related financial disclosures are required to be for the same reporting entity as the related what? Financial statement. So that's also very critical, very part. So it must be what? It must be for the same reporting entity as related finance. Like I told you, you must do it along with your what financials. Okay, that's what IFRS S1 is what saying. Okay, so now that means that the standalone that you prepared separately is no longer applicable. In fact, it should now be incorporated into your what your financials. Okay, all right. It says now it is required to provide information in a manner that enables users of general purpose financial report to understand the following type of connection. One, the connection between items to which the information relates, such as connection between various sustainability related risks and opportunities, the connection between disclosures provided by the what? By the entity. Okay, now let's look at reporting entity and connected information. Okay, sorry, this is a repetition. Sorry. Okay, then let's look at now core content of what now. Unless another IFRS sustainability disclosure statement permits or requires otherwise in specific circumstances, an entity is required to provide disclosures about the following issues in your what? In your sustainability reporting. One, governance. So the first issue you report is on governance. Your corporate governance process, controls, and procedures the entity used to monitor and manage what? Sustainability related risk and so you talk of from a corporate governance part, what are the processes or procedures that a company has put in place to manage what? Sustainability issues. Okay. Two, strategy. Please write this down. Those are the core areas in what? In IFRS report disclosure requirements. Strategy. The approach the entity uses to manage sustainability related risk and what? So how do we intend to go about managing those risks and opportunities? Then we talk of the impact of sustainability on our risk management. Okay. Process the entity uses to identify, assess, and prioritize and monitor sustainability related risk and what opportunity. Then lastly, metrics and targets. The entity's performance in relation to sustainability related risk and opportunities, including progress towards any target that the entity has what set. So we look at metrics and targets. What are the targets and how are we achieving or comparing our performance with what targets? Then an entity is required to provide disclosure required by IFRS sustainability standard as part of the general purpose clearly stated. So we incorporate it to our what? Our financial statement according to IFRS S1. Then please, we must give a statement of compliance, just like with IFRS. An entity whose sustainability related to financial disclosures comply with all the requirements of IFRS must what? Make an explicit and unreserved statement of compliance. They must say that these disclosures fully comply with what? IFRS S1 and S2. You must clearly state it in your what? In your financials. Then effective date and transaction. An entity is required to adopt IFRS S1 for annual reporting period beginning on or after 1st January what? 2024. Okay. All right. So please, that's sustainability reporting. Thank you.